Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure of speaking to our old friend, Jim Bianco, president of Bianco Research. Jim, always a pleasure when you join us.
Thank you, Ash. I'm looking forward to it. I even put my TradFi uniform on for you.
You are a full-on TradFi here.
Yeah, exactly.
Listen, I should say before we get started, just a quick reminder, tickets for our upcoming in-person crypto gathering in Miami are now up for sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Jim, with that said, it's such a pleasure to have you with us. So much happening right now in markets here as we roll up to the end of the year. It's great to have you to do your big year-end wrap, New Year preview, 50,000 foot. Where do you see us right now?
The U.S. economy stands alone in that it is much stronger than what we're seeing in the rest of the world. As a matter of fact, I like to joke that whenever you see people online media or social media, glooming and dooming about terrible things that are going to happen, they're largely right about everywhere but the U.S. German economy might be in a recession. The Chinese economy is growing at maybe its worst level in 40 years. The Japanese economy's got about zero growth. The emerging markets are struggling, and the U.S. is booming. It is booming along right now. And we're 32 days away from the day we're recording from Donald Trump becoming president, and we're expecting even more stimulus in the form of tax cuts, deregulation, that's Doge, and potentially even a tick up of inflation because of tariffs. So from that perspective, the economic perspective, the U.S. economy is doing good. Now, from the market perspective, it's a little bit of a different story. The financial markets have had a great year. Stocks are booming, crypto's booming. Even gold has gone up a lot this year. This is going to be, unless something dramatic happens in the last 3 or 4 trading days of the year, this is going to be the first year ever that gold and the S&P are up more than 25% in the same year. And it might be for the same reason, and that gets me to buy market and the Fed, that the economy is doing great, everything is doing great, and the Fed is cutting rates. And I think that the bond market and the gold market have been saying, no, we don't need this. We don't need extra monetary stimulus. You're just creating higher inflation expectations. Bond yields have been rising. Gold has been rising. And the stock market and crypto is saying, yeah, I'm a junkie. Give me free money. Let's go. And they're going up as well, too. That's indeed the case, and I think it is. That's not going to be sustainable in 25. One of these two things is going to have to give. Either the inflation story has to dwindle away, and yes, we can keep these lower rates and continue to cut, or the inflation story puts all of this to an abrupt halt, and then the risk markets have gone too far.
Well, that word, or, really at the very heart of everything we've been talking about here in markets for the last 48 hours or so. Let's talk about that. Let's break it down. What's happening over at the Fed? This hawkish cut, a phrase I always find paradoxical, right? What does all of this mean? What's the significance? And how is the Fed thinking about these markets?
So let me start with that hawkish cut word. I don't think that's a thing. I think that hawkish cut is kind of a euphemism for the Fed screwed up, is basically what that means. But we just can't say that the Fed screwed up. The Fed started cutting rates in September. And what's interesting is they've now, with this week's cut the short-term Fed funds rate 100 basis points or 1 full percent. Through yesterday's high, the 10-year yield over the same time period went up 100 basis points at the same time. That has not happened in 40 plus years, that the Fed has been lowering its rate and long-term market rates have been rising. What is that signaling to us? I think it's signaling to us a rejection of the policy. No, Jay, we don't want these rate cuts. You're not stimulating the economy. You're not making it cheaper to buy a house. You're not adding jobs. You're adding more inflation. Or at least we are fearing you're adding more inflation. And that's why rates have been trending higher during that period. The only overlay that we have of this is what we've seen with the Fed cutting rates and long-term yields going up is the 60s and 70s when we were legitimately worried about inflation. And every time the Fed cut rates, it was like the market was saying, no, don't do this. And they punished the Fed by going higher. So the question is, this hawkish cut, which, like I said, that's just a euphemism for the Fed's got the wrong policy. Why is it that the Fed has been doing this? Let's go back to July and August. Two things happened in July and August, and I think it spooked the Fed. First of all, we got the so-called Somm rule. That's named after Claudia Somm, who was an economist at the Federal Reserve. And it was that if you take the 3-month average of the unemployment rate and it goes above 0.5% above its previous 12-month low, so if you're more than 0.5% above the 12-month low on a 3-month average basis, that usually triggers that the U.S. is in a recession. Well, that triggered in July. And then in August, we got the QEW revision. That's the quarterly economic forecast to the revision of the payroll report based on it was based on tax returns, and it took 818,000 jobs out of the economy. I think those two things made it politically impossible for the Fed to not respond, especially before an election. Hey, look, we got the Somm rule trigger. Maybe it's not. We've all come out and downplayed it, but it's there. What if it's right? We got the revision down of payrolls. What if that's a signal and we're not looking like we're responding? Cut 50. So they cut 50 in September. It was a political decision, especially because it's 7 weeks before the election. And they followed through on it. Well, what's happened with the economy is the labor market has rebounded. Most of the labor data has looked better than it did in August. And the market has gone with rates higher. Jay Powell, we're not all the way through the inflation problem. You're presupposing we are. Inflation data is looking a little sticky over the last several months. And you cut rates based on this idea that there was some weakness in the labor market and it's not there. Now you get to Wednesday. And I think what happened on Wednesday, look, if I read the transcript and if I was to hand that transcript, here's what the Federal Reserve said at a presser to a typical Wall Street economist. They'd read it and go, so they hiked rates. No, they actually cut rates on Wednesday.
Right.
But they downgraded the assessment of how many more rate cuts they're going to do in 2025. And I think the response to the transcript would be, what do you mean they're going to cut more? This is a prescription to hike rates, is what they said. They upped their forecast for inflation for next year and for 2026. They said they're not going to get to their 2% target until 2027. They said that the economy's fine, GDP's strong, and they upped their inflation forecast. Why are you cutting rates? And I think the answer is they're political again. They're afraid of this big Truth Social account held by one Donald J. Trump, that if they stop cutting rates or hint that they're going to stop cutting rates or hike rates, he will unleash the third level of hell on them. Because you were cutting rates when I was running for president. And then when I became president, you're going to stop and hike. Now, that might actually be what they wind up doing, but at least they didn't admit it on Wednesday. And I think the market reacted, the bond market reacted badly to this. We don't need you holding out hope for more rate cuts. We don't need you searching for reasons to rate cut again, because you're going to find them and do it and dig us into a further hole. We want you to stop. And if you won't stop, I'm not interested in owning bonds. They sold bonds, and that's why yields went up, and that bothered the stock market. So hawkish cut means Fed mistake. The mistake is the market is telling you with this 100 basis point rise in the 10-year yields in September, we don't need these cuts. Stop it, Jay. But he hasn't stopped it, and he's holding out hope for more. Well, if you're not interested in fighting inflation, I'm not interested in owning your bonds. And that's why we're seeing yields start to drift higher.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
I'm thinking about getting t-shirts printed up. There are no paradoxes, only mistakes. Jim Bianco.
You know, there's a lot of truth to that.
Jim, so much right there. I mean, that really is a narrative that arranges all the data points that we've seen. I know this gets very technical very fast. Let's go back here and just explain to folks who are trying to get their heads around this, who don't have strong backgrounds in monetary policy, the way that this is supposed to work. Talk about these policy mechanisms from the perspective of the way they function under normal environments. And then we'll contrast it a little bit and fold in a little bit more of what you just described there, because this really is the heart of all of these paradoxes, mistakes, challenges, conceptual frameworks that are getting bent right now around what's happening right now in asset markets.
So normally Fed policy, you know, is they set short-term interest rates, which are the borrowing costs for banks and the borrowing costs for brokers. And that's supposed to reverberate through the rest of the financial markets, mainly interest rates. And the idea is that lower interest rates make it cheaper to borrow, encourage more borrowing, and are stimulative for the economy. Higher interest rates do the opposite. They make it more expensive to borrow. Think of your mortgages. You don't want to buy a house when you got 9% mortgages, but you're more interested in buying a house when you have 4% mortgages. So it's kind of the same idea. Now, normally, the Fed policy is a response to what we're seeing in the economy. When they lower interest rates, that should reverberate through, and all interest rates along the yield curve should go down to varying degrees. They should go down. They don't go down one for one, but they should all kind of have the same path that they travel south. They go down when you cut rates north. They go up when you raise rates. And that should be somewhat stimulative. That's the way it should work because the market is in agreement with the Fed. Things are slowing down. Inflation's not a problem. Cheaper money to encourage more stimulation or stimulate the economy more is appropriate. We get in these rare instances when the Fed says, here, we should give you cheaper money. And the market is saying, no, I'm not interested in cheaper money. But why not? Because remember, as a bond investor, they're called fixed income. You get a coupon and it's fixed. It doesn't change. If the inflation rate is going up, that means what you're earning after inflation is diminishing. Now, I don't want to own an asset that has a fixed income if inflation is rising because it makes it unattractive. So if the Fed is going to lower rates to stimulate things, and the market thinks, no, all that's going to do is produce higher levels of expected inflation, we sell bonds and yields go up. And we get the opposite reaction of what we're trying to do. So at the heart of it is a misjudgment about what is the level of the economy. And the Fed thinks that the level of the economy needs cheaper money, needs more stimulus. But the marketplace, the interest rate market, is saying that, no, we don't need it. And right now, Ash, I should point out something else I tweeted out yesterday, and I'll just summarize it. The stock market, the gold market, the alternative market, the crypto market cannot destroy the bond market. But the bond market can destroy the stock market, the gold market, the alternative market, and the crypto market. Why? Because the borrowing cost for money drives everything. And if the bond market loses confidence and people run away from it, I understand there's a bunch of crypto bros. Yeah, who wants bonds? They return 2%, 3% a year. We do that in 10 minutes in the crypto market. Fine. Drive interest rates up. And that is a destroyer of worlds. It will destroy everything because it will make it uneconomic for everybody else if you drive up interest rates. And that is really what we're concerned about with this big rise in rates is, are we going to tighten too much and make things uneconomic?
Destroyer of worlds. This is like Oppenheimer quoting the Bhagavad Gita at the Trinity test. Let's talk a little bit about this because I think it's important for people to understand the impact of the bond market the bond market, as you point out, drives everything, drives the cost of money, and has the ability to upend virtually every other risk asset class. Talk a little bit about that. By the way, we should say we saw whatever it was, a 12, 15 basis point backup in yield on the 2 on that news on Wednesday. Talk a little bit about it. Frame it up, Jim.
Yeah, it's exactly that, is that when you start off with any investment, whether you're buying a business, you're buying a stock or a bond or a crypto, you always start to think about, well, I'm going to buy this, and what is my alternative? Is to put my money somewhere else, even if it is to leave it in the bank and earn interest. Well, the starting point for all of those alternative investment ideas is the cost of money. What is it costing me? What is money costing me? And if I was to put this money into an investment and they need to borrow money, how much is it going to cost them to pay it back? And how lucrative does that investment become? If I could leave my money in the bank and earn an interest rate, like 4% in a money market fund, is that lucrative enough that these riskier assets don't provide a good risk reward ratio? So the cost of money is where everything begins. And that is why when we look at the bond market and we look at interest rates going up and going down, it changes the calculus for everybody. And don't forget that the bond market in and of itself is an investment on its own. And the idea of the bond market is it's super safe. It's not going to default on you. It's not going to, to use the crypto term, you're not going to get rugged in the bond market. Other than the price might go up or down a little bit. But not to the extent that riskier assets do. And so there are a big class of investors who are willing to invest in that because of its safety. And the risk that they take is very minuscule compared to everybody else. But the impact of what they do is huge because they change the level of borrowing costs.
Yeah, I guess if you wanted to make the case that you could get rugged at the bond market, it would be toward the long end of the curve. And what rugs you in this scenario would be inflation. You're getting paid a fixed coupon, and you see the purchasing power of the coupon payment erode over time. That would be the thesis, at least.
Yeah, exactly. And that's really what you're looking for. You're ideally in the bond market, what you're trying to get is a real return. You're saying, what is the inflation rate? And I want this super safe investment to return me more than the inflation rate. So at the end of the year, end of 5 years, or whatever your time frame is, I have more real money, real after inflation money, so that when I go to the store, I can buy more than I could have before because my money went up faster than the inflation rate. And so it's safe. It doesn't offer you, it doesn't offer you, to the moon or anything like that. But what it should offer you is an increase in your wealth.
Jim, do you look at break evens? Do you look at tip spreads on this as an indicator?
I do all the time. Yes.
So talk a little bit about that and perhaps explain to folks who may be looking more closely at the equity market and the bond market, the significance of tip spreads and break even rates.
So the Treasury issues a different type of Treasury security called a Treasury inflation protected security, or a TIP. It pays an interest rate. Sometimes that interest rate is negative, but that's okay. And then every year you get, or every month actually, you get more bonds based on the inflation rate. So you buy these Treasury tips and say they have a 1% coupon. Okay, but a regular Treasury, a 10-year Treasury has a 4.5% coupon. Yes, but every year, if the inflation rate is 3.8%, they give you 3.8% more bonds at the end of the year. They refer to that as accretion. And so it gives you the inflation rate plus a real yield. And that is a very attractive investment. Now, if you take the yield, what we refer to as the nominal Treasury, that's the one that is the fixed income one that yields 4.5% that you see quoted all the time, subtracted by the yield of the tip, you get what is called the inflation break-even rate. That is, if we use the 10-year, which is a standard, or the 2-year, or the 5-year, what the marketplace thinks the average inflation rate will be over the next 2 years, if you look in 2 years, 5 years, or 10 years. Not the next year, but the average over several years. So It's a market assessment of what they think the inflation rate will do. And so people look at these things closely to say, is the market expecting more inflation or is it expecting less inflation? And it tells us things about why interest rates are going up or why interest rates are going down. What's been happening since September is if you look at the 2-year and the 5-year tenor, those break evens, so the 5-year yield minus the 5-year tip or the 2-year yield minus the 2-year tip, those inflation break evens have risen by almost a full percent, which is a very big move, especially over this period of a couple of months. So the market is expecting 1% more inflation than it did in September. Now, September is when the Fed started cutting rates. In addition to that, I'll throw out one other thing. What is the biggest influence on the shorter term tips numbers? It's the price of gasoline. If the price of they usually go up and down with the price of gasoline. But since September, the price of gasoline has continued to fall. The national average has continued to fall. And its expected inflation has continued to rise. Even more powerful of a signal, the market is pricing in more and more inflation despite gasoline prices falling. So what the inflation break-even rates can do is they can give you a message from the market. Why are rates going up? I mean, there are several reasons interest rates can go up. One of them is because you're getting more inflation expectations. And that's what I think we've been seeing in the marketplace over the last couple of months, is it is expecting more inflation and interest rates are going up. That's the bad reason for interest rates to go up. The good reason is you're expecting more growth and interest rates should approximate the growth of an economy. That would be the good reason. But unfortunately, we're seeing some of this for the bad reasons. That's why the bond market or the stock market, I think, over the last couple of days has been seeing some turbulence in the wake of higher interest rates. The interest rates are going up for the bad reason, that we're expecting a little bit more inflation, and not the good reason that we're just expecting more booming growth.
Jim, that's so well said. That's so well explained. Let's talk a little bit about the stock market. By the way, coming up here on a trailing 12-month and year-to-date basis, which are both starting to converge as we get to the end of the year, nearly 27% annualized return on the S&P 500, close to 29% on the NASDAQ 100. I mean, these are very, very big numbers. I think one of the few things that's always true in markets is it's always easier to sound smart as a bear than it is like a bull. But these returns have been pretty extraordinary relative to the historic rate of return on these indices. But, if you flip on like Drudge Report, one of my guilty pleasures for the last couple of days, you see these, these headlines like, the worst 3 10 days in the stock market in the last 30 years, meaning that there've been significant, there've been back-to-back sequential declines in U.S. equity markets for a longer period of time than we've seen in 30 or 40 years. These numbers probably a little bit distorting when you look at just these returns on the last 12 months. Talk a little bit about your outlook for U.S. equities and that disconnect between some of the gloom and doom that you see in the more sensationalistic headlines versus what's actually happening in the underlying markets.
So let's put some color on those gloom and doom headlines. What they're talking about over the last 12 or 13 days is what's referred to as market breadth, the total number of stocks that have gone up versus the total number of stocks that have fallen. And that has declined for, through around December 19th or 20th, 13 days in a row. And that's the longest streak ever that we've seen the breadth of the market fall. We also saw the Dow Jones Industrial Average decline for 10 consecutive days through the 19th of December. And other than 9/11, and that was a disconnect because the market was closed for a week in there, you got to go back to 1978 to find that the worst 10-day period in the stock market or in the Dow Jones Industrial Average. But at the same time, until the Fed meeting, the S&P was up, the NASDAQ was up, so the market, so other measures of the market that are more traditional look to be doing better. So the point I'm trying to bring up is there's these huge divergences in the way that this market has been trading. Now, part of that is because of the nature of this market and that we have 7 stocks, the Magnificent 7 stocks headlined by Apple and Nvidia, that are 1/3 of the S&P. And they're half. You said the stock market's up 29% year to date or 27% for the last year, half of that is 7 stocks. That is unprecedented to see the market have so much of its gain concentrated in just a handful of stocks. So it's been an unusual pattern that what we've seen in the market. Now, what does that mean? What does that mean in the context that the market has gone up 29%? Other than it's been a very concentrated market, I think it tells us that beyond a few sectors, the gold sector, the Mag 7 stocks, some healthcare stocks, a few others, the broad measure of the market has had an okay year, but not nearly as good a year as the headline indices have been implying. Let me take one last thought on this. You mentioned the stock market's up 29% this year. It was up 23 or 24% last year. So it's had 2 good years in a row. The problem with the marketplace is everybody defaults to momentum. And what that means is, what is the outlook for next year? Well, it was up 29% this year, was up 23% last year. So I guess it keeps going up 20% a year. And that's kind of a minimum investment is 20%, because that's what it's been doing.
Right.
No, that's not necessarily the case. That just because the market was up big last year or the previous period means that it's going to be up a lot the next period. And that momentum, the problem with momentum, to quote that famous line from the movie Top Gun, is that some of the best flying I've ever seen, some of the best investing I've ever seen, right up until the moment momentum stops, right up until the moment you were killed. And that's the problem with momentum. If you're a momentum investor, my God, look how much money I'm making until that moment I'm killed, and it all goes away when the momentum disappears. Because momentum can disappear quickly and abruptly and without warning. And that's the problem with being a momentum investor. So turn that around. Let's look at it. Let's look at valuation. Now, most people say that valuation cannot be used as a timing tool, and they're 100% correct. Valuation does not mean that the market can't go up another 20% in 2025. It can. But what valuation typically will do is give you an expectation. What should you expect the stock market to do from December 20th forward? Forget what it's done until this day. What should you expect over, say, the next 10 years going forward? Start with valuation. The valuation in the stock market is extraordinarily high. If you look at some of the work that Professor Siegel at Wharton University Wharton School, if you look at the work that Bob Schiller has done at Yale University, they've done a lot of work on valuations. In fact, Bob Schiller won the Nobel Prize in economics on his equity valuation work about 15 years ago. They would tell you that from this moment forward, over the next several years, given the high valuation in the stock market, you should expect a 6 or 7% return in the stock market. The bond market is offering you 5% yields. And so that is really the type of environment we're in. Now, I know when I say that, the crypto bros are like, you mean 6 or 7% a week, right? Not 6 or 7% a year. You mean that, Tom Lee is saying that the Bitcoin should be 250,000 next year. It's going to go up 150%. Those are the types of returns that we expect. Well, maybe that happens over a shorter period, but given these stretched valuations, it's going to be very difficult to see those outsized gains. Remember, if you go back to the late 2022, the stock market had already declined 25% in 22 for most of the year. So we started from a very cheap valuation, much lower base. Now we're into record territory, both in prices and near record territory in valuation. And that's why I think it doesn't mean the stock market has to go down. Sure, it could have another decent year in 25, but then this same argument I would give you would be even worse in 365 days, saying looking forward over the next several years. The argument you would make that 25 is going to be a good year is a momentum argument. And like I said, that will work until the moment it stops working. That's the nature of momentum. It stops working without warning and reverses badly. And that's what you have to be careful of as being a momentum investor. The problem with being a valuation expectation investor, expectation is you might say, look, the stock market might give me 6 or 7%. I'll stay invested in it. But if the bond market can offer me lower volatility and 5%, I'll put some of my money in that. And then momentum takes over in the first quarter and the stock market's up 8% in 3 months and you feel like a chump because you didn't play that game. But like I said, at any moment, and momentum investing can end without warning. So that's the discipline you have to have with investing. What do you expect? What if it doesn't work out the way you think, how you're supposed to invest in it? And my discipline now says, look, 6 or 7% is a good investment. 5% is a good investment if we are in a 3 to 4% inflation world. Over time, that will create wealth for you. But unfortunately, we're a gambling society, and we're not thinking about over time. We're DraftKings, we're FanDuel, we're Bitcoin. We want to score a huge killing now. And that seems to be what's overriding that.
Jim, so well said. Such an important arrangement of all of those data points in that narrative. Look, I used to have an uncle, late uncle, who was a passionate amateur recreational parachute jumper. He used to say, it isn't the first 10,000 feet, it's the last 6 inches that kill you. This is the challenge with momentum in markets. You made so many good points, and I just want to start unpacking some of them here. The first is this idea of the sequential declines here in the market the last, whatever the number was, 13 or 14 days in a row. Probably important to point out when you look at that on a 30-day chart, it does not look dramatic. It does not look ugly. These are not what really matters in terms of declines, which are percentage declines. This is the number of days with sequential decline closes down from open. One interesting metric to look at, but perhaps overstated in terms of its significance for what it actually means to markets. But the point that you did make there that was really interesting there too, this idea of valuation and equity premium on the one hand and concentration risk on the other. When greater and greater returns come from a smaller and smaller percentage of issues in the market, often a signal of trouble. If you look back to the Nifty 50, I mean, this is a decades-long pattern that we see. How significant do you think this concentration risk is in markets? Is it just a function of the way that markets are trading, or is there some underlying tie-in with the real economy that's causing this, that perhaps signals something in the way of concentration or inequality risk broader in the society and in these companies?
Last week, Goldman Sachs had an investment conference, and they had Mark Rowan speak at it. He's the head of Apollo. You might also remember that Trump interviewed him to potentially be Treasury Secretary. At the investment conference, he talked about the current state of investing. And he said, when it comes to the stock market, and this gets to your point about concentration, the single most important person in 2025 for the stock market is not Donald Trump. It's not Scott Bassett, the presumed incoming Treasury Secretary. It's not Jay Powell. It's not Mark Rowan. It's Jensen Huang, the president or the head of founder of Nvidia. Everybody who owns equities is got their fortune tied to Nvidia. Whether you own it directly, you own it in a concentrated tech fund, or you own a broad-based index of the S&P 500. So goes Nvidia, so goes everybody else's investing. So you've now made a decision on a portfolio. You've made decisions on stocks. You've made a decision on being long or short Nvidia. No, I didn't. I don't own Nvidia. I didn't consider Nvidia. It matters that much. And if you broaden that out to the Magnificent Seven stocks, it matters that what they do for everybody's returns. The influence, the impact it will have on world stocks is going to be huge. Those stocks as a group are up about 60% this year. And so with its strong momentum and with its hope that AI is coming, can be, when their momentum turns, it can be very, very painful. It can be very strong. Look, is AI coming? Yes. Can AI be bigger than the internet? Yes. But that's not good enough. That's not good enough to say that. I need it here by the end of 25 or early 26. I need to see business models and lifestyle changes that are coming because of AI in 12 to 15 months. like we've seen lifestyle changes because of the invention of the internet and social media bring about the way we live our lives has changed because of that. I need AI to be that fast. If it isn't, those stocks might be ready to fall. If you tell me, no, be patient, it's coming in 3 to 5 years, they're not priced for it to come in 3 to 5 years. They're priced for it to come in 12 to 15 months. And that is the concern you have. Now, if you're going to tell me, no, there's going to be this massive AI boom, there's going to be hundreds of thousands of people that are going to be displaced from their jobs before the end of next year. We're going to create an entirely new industry because of AI and what we can do with jobs. Okay, make me the case that it's going to happen that fast, because I don't see it happening that fast. I'll give you one overlay on this. In December of 99, Jeff Bezos was Time Magazine's Person of the Year. He was Person of the Year because of what Amazon represented. And Amazon represented a whole new way of doing retailing. 13 years later, in 2012, Amazon's stock was at the same price that it was in 99. Where's this retailing boom that you guys were talking about? We're 13 years later, and it didn't do anything. Then the stock went up 300x. After that, we got the major retailing boom. The 99 story was not wrong about what Amazon was going to do in terms of its impact on retailing, so much so that Jeff Bezos was Man of the Year. It just took a lot longer than everybody thought for it to unfold. I'm not saying that Nvidia is going to be at the same price in 12 years. I'm saying that when you get this kind of move, you got to be, it's not good enough to tell me what their chip is going to do. It's not going to be enough to tell me what large language models are going to do. You got to give me the date at this point. That's what happens when you get these big numbers. Otherwise, markets get very impatient and they could correct very hard. And so that's what concentration does. And that's what the concentration means. I am, you are, everybody's listening to us. Jensen Huang is going to be a major player in our investment returns next year. Whether we own his stock, considered his stock or not, it's going to matter for everything.
So many important points there to talk about. By the way, I wrote up a document about this because it was so powerful when I looked back at that case study. Amazon lost on a peak to trough basis 95% of its value between December 1999 and September 2001. To your point, the revolution was digitized. They did, in fact, create a massive value for shareholders by revolutionizing the shopping model and then doing cloud and a whole bunch of other things. But boy, was it absolutely brutal. For those of us who were working on Wall Street at the time, as I was, I remember it like it was yesterday.
Yeah, you're right. And in 01, 95%, that means you need a 20x return just to get back to those 95 levels. And the market was still, by 2012 at those, 99 levels. So that peak in 99 was still there at as late as 2012. It was well off that 2001 low. But yeah, I mean, that was the thing about Amazon. Where is this retailing revolution going to come from? I get the idea in the abstract, but in the reality is, where is it? Well, it came in a big way. And Amazon also created, AWS, created Prime, created a lot of other things along the way that was an adjunct to that as well too. But it took a lot longer than we thought. But when it did arrive, it was culture shifting. It was lifestyle changing. We all live our lives differently because Amazon was created. And that could very well be the case with AI. I have no doubt. But like I said, when a stock like Nvidia goes to $3 trillion and when Tesla starts to take off and Alphabet takes off as well too, and Meta starts roaring ahead on the whole idea that we're going to have this AI revolution, it has to happen now. It's not somewhere in the future there will be wonderful things coming because of AI. They're putting a time limit on it, and that's what you have to be careful of when you see big momentum in stocks like that.
Yeah, and it's such an important point. The revolution came, but it did not come on the time horizon that U.S. equity market investors were pricing the cash flows, which gets back to your earlier point. And maybe we can just talk a little bit more about this. I know we're probably running out of time, but this is such a great conversation, Jim. It's one that I don't want to end, and I'm sure our viewers and our listeners don't want to end either. You mentioned the work of Robert Schiller, CAPE, the cyclically adjusted price to earnings ratio, the valuation of this market, the valuation of those future cash flows in terms of investor expectations. Talk a little bit about that because it's so critical to understanding the really longer term view of the market as a weighing machine rather than as a voting machine, to borrow from Warren Buffett and Charlie Munger.
Yeah. So you're right. Schiller's work, he created the cyclically adjusted PE ratio, which is like a 10-year average of the price to earnings ratio. If you take the reciprocal of that, you get the earnings yield. If you compare that to real bond yields, which is what he does, look, what is the bond market offering? Remember the bond market, destroyer of worlds. So that comes in full center in his calculation. This is what I can get in the bond market after inflation. This is the earnings yield that the stock market is offering me. And he comes up with what's called the CAPE excess yield. And the higher the valuation, the lower the excess yield becomes. And right now, what he's basically telling us is the bond market can offer you about 1.5% more than the inflation rate. And the stock market offer you about 1.2% above that. And that's not, given the risk that you have in the bond market, to just get 1.2% more than the bond market, and that's the CAPE excess yield, is not a very good deal. I mean, or I shouldn't say it's not a very good deal. It makes the bond market very competitive to it. It's a far cry from where it was in 2019, when the gap was 6 or 7 or 800 basis points or 8 full percent. That was the TINA years of there is no alternative, get out of bonds, get into stocks, but that's not the case anymore. Now, if you take, these yields, and remember we're talking about rising yields. You take an Nvidia, you take a Meta, you take a Google, and you say, okay, AI is going to mean, these types of returns in the future. Well, you have to discount them by an interest rate to say, what is that worth today? What is those future returns worth today? And when interest rates go up, those future far out returns get discounted a lot more. They're worth a lot less today because they're out in the future. So the valuation idea is, if interest rates are going up and you're telling me there's going to be an AI revolution, but push it out a couple of more years, it's not going to happen in the next 12 to 15 months. It might happen in 3 to 5 years. Well, as higher interest rates go and the further out those future profits become, they're worth way less today than they would have been if they were going to be in 2 years with lower interest rates. If they're in 5 years with higher interest rates, they're worth a lot less. And that's the thing that could wind up killing momentum. So that's why I said the problem with momentum is it's impatient. The market is pricing in gains, profits from AI now, and you have to deliver it now. You cannot have a problem. You cannot say, it's coming, trust me. That's what happened with Amazon. That's why Amazon took 13 years. We so priced in the AI revolution, which did come. It just came much slower than we thought, which is why it took so many years to make a profit. And that is for any momentum-driven investing. The same thing is, like you could say with crypto. Bitcoin's at 100,000, and everybody's talking about an adoption cycle. And you might be right. There might be an adoption cycle, but it better be 2025. It better be right now that there's an adoption cycle. Otherwise, going back to interest rates again, those future adoptions become worth less and less if they're pushed out further and further into the future. And so that's why when you have momentum markets, there's an impatience with the market that it has to deliver on that now. What we need to see, say, to stick with crypto at 100,000 is, here come the boomers. All right, give me solid evidence that there are boomers that are transferring serious sums of money to crypto because it's above 100,000 and they have to be invested in it. The Wall Street Journal did a story on this earlier this week. They found one guy in Tennessee that bought $1,000 worth of crypto. They found another guy in Finland who bought $1,000 worth of Bitcoin for exactly the opposite reason. One guy bought it in Tennessee. He said, I'm buying $1,000 worth of crypto because I believe Donald Trump is going to push prices higher. The guy in Finland bought it because he said it's a hedge against the world falling apart. So one guy's optimistic, one guy's pessimistic, and you found two guys that bought $1,000 worth of it. That's not adoption. Those are kind of those are kind of exceptions to prove the rule is what that is. So that is the problem with momentum investing, even in crypto, is that you're betting that there's going to be a TradFi adoption, and there will be one, but it's got to come in 2025. If you tell me that the TradFi adoption is 28 or 29 or 30, 3, 4, or 5 years from now, there could be a big disappointment. My point is not that I'm saying the prices will go down, is when you have momentum, there's an impatience in markets. It has to happen now. It's been priced in to happen right away. And if it doesn't, considering the discounted cash flow arguments and stuff, that if that adoption is in the future, then there's a severe disappointment in markets.
Listen, to our listeners and viewers, if you're listening to this narrative right now, this is the way that pros think about markets. This is what's so important to understand from an institutional cash flow perspective, to understand those price gyrations that occur underneath the surface when they don't seem to make any sense, perhaps to casual investors in these markets. Such an important conversation, Jim, such important insight.
Can I add to that about
the
way the pros think about that? Is because if you're a professional investor, you are measured against a benchmark and you are constantly saying, I own Bitcoin, I own stocks, I own bonds. I could own a myriad of other investments at continuously. I could trade out of these into other investments. Should I be trading out of these into other investments? And that is a continuous question you ask yourself. Pros don't say, which retail, you have an advantage with retail, right? You can say, I'm going to own some Bitcoin and I will look at it for 2 years and see how it performs. Or I won't look at it for 5 years and I know it will be higher. The problem with a pro is he gets paid every quarter. He gets paid every year. He has to constantly beat an investment benchmark. So he's always thinking, well, I was in Bitcoin. It had a great run since November, but I got to think about how I'm going to beat my benchmark in 25. And if that adoption wave doesn't come, I'm on to something else. I'll come back to it later, maybe when that adoption wave comes, but it's always constantly being measured against alternative investments. And that's why the pros can get very impatient. I need it to happen now. Otherwise, I've got other ideas. Think about it as if you're the general manager of a sports team. Ash, you might have a good slider and a good curveball, but I need you to get people out now because I got 12 other guys in the minor leagues that can get people out. And if you can't, you're going to get replaced. And that's the way that these investors kind of think. They kind of think the same way like managers or general managers of sports teams are. I need you to get a first down now, Mr. Running Back, if I hand the ball to you. If you aren't getting first downs, I got other running backs that I'm going to try. And that's the way that these investments are as well, too.
Yeah, not only beat their benchmark, but beat their benchmark more than the average of other active managers net of fees.
Right. It's a brutal business. It is a brutal business that you've got to earn your, we refer to that as alpha. You've got to generate alpha, which means above just the benchmark, above just, doing nothing. And you've got to do it all the time. And if you did it last year and you did it last quarter, how are you going to do it next quarter? How are you going to do it next year? That's why it's a very difficult business to be a professional manager. And they're well compensated for it, those that can do this, because they're constantly thinking about at every moment. Paul Tudor Jones, there was a book called Market Wizards written by Jack Swigert in the late 70s. And Paul Tudor Jones used to talk about every time, and he was a commodity investor. I'm long corn. I could be short cocoa. I could be long cotton. I could be long bonds. I could be short the S&P. Every moment of every day, I say, if I'm long corn, is that the best investment out there? But at any moment, I could say, no, I'd rather be short cotton. Bam, I just made a change, is what they wound up doing. And that's the way that professional investors always think about these things. They don't rationalize, or at least the good ones. They don't rationalize. They don't say, well, cotton is struggling, but it'll come back or something like that. No, I'm on to the next idea because it's a brutally competitive business.
Such an important insight. And by the way, you want to talk about alpha, add to that the idea of volatility. So even if you are beating your benchmark, better than your competition, you don't want someone to say to you, yeah, sure, but you just got lucky this year. You loaded up on volatility, and that's why you won this year, but maybe next year you'll lose.
Right. And the way you kind of get away from that argument that you were just lucky, you made one good bet, or maybe you just, you backed into it, is you do it consistently. And then the argument is, what is the probability that you're consistently doing it because of luck? it goes down and it implies a skill level. And that's how the really good investors get very, very well paid, because they're suggesting a skill level because it's a consistency in the way that they do it.
Yeah, such an important way to think about these markets for people who maybe have not had the opportunity to work on Wall Street, to understand the way that this works from a professional institutional investor perspective, which also gives you the insight into how you see those institutional flows.
Right. And as a retail investor, you don't have to play that game. You could play the game that I like Bitcoin, I like the S&P 500, I like bonds, I like whatever. And I think that between now and then, if it goes to 300,000 in 5 years, I'll just use the Bitcoin example.
Right.
I'll be fine. But if it goes to 50 first, it goes to 50 first. But a professional investor can't show his investors that in 2024, I returned you 50% because I had a lot of Bitcoin. But in 2025, Bitcoin halved its price and I returned you minus 30. And then in 2026, when Bitcoin recovered, I returned you 80. Then the professional investor is losing because people say, you're random. You're random and you're not showing a skill set. So you have an advantage if you're a retail investor over the professional investor. You don't have to play this ulcer-inducing game of constantly trying to beat a benchmark like they do. And the problem is, the reality is, well, why aren't the investors of professional investors, the money raised from the professional investors, why aren't they so? The problem is they are the ones that are very impatient. Look at Cathie Wood and look at how she was thought of by 21 or 22. She was being compared to Warren Buffett, and then the market, for those tech stocks that she owned fell 60 or 70%, and then on the upswing, she didn't own the big Mag 7 stocks because that was never her bailiwick. She wasn't fully in on Nvidia, wasn't fully in on Meta for the rebound. So while the ARK fund is recovered, it's not back to its old highs that it set in 2021. So why, you can argue maybe if she was given 5 or 10 more years, she'll be proven out. And she very well may be. But the problem is it's investors that are impatient with her and move on to the next player. So it's investors that force you to constantly have to beat every quarter and every year because they'll leave if you're not. They don't have that kind of belief in you or staying power in you.
Yeah, so well said. Jim, should we talk a little bit about crypto since you mentioned it?
Sure. Where do you want to go with crypto?
What's your big picture take on what's happening right now? Obviously, we've seen a significant rally, probably on the idea that there's going to be a decrease in headwinds from a regulatory perspective with the incoming administration versus the outgoing administration. But what's your big picture perspective for 2025 on crypto?
I think that's exactly why we saw the big move from 50, high 50s to 100,000 in Bitcoin in 2025 or since November. And what's been interesting about it, of course, is short of Fartcoin, it's been largely a Bitcoin-driven investing. ETH has lagged a little bit, although it's catching up somewhat. Sol has lagged a little bit. Some of the other cryptos have lagged a little bit. I think that, as far as the regulatory headwind goes, I think that that's largely been removed with Paul Adkins at SEC, Bassett as Treasury, Lutnick, at Commerce, and Trump's pro crypto stance as well. But I think that's already in the price. I've been one that's argued that what ultimately crypto needs to do is break its correlation with the NASDAQ. Let's go Michael Saylor. Michael Saylor is got a forecast out there for 20 years that Bitcoin's going to go to 13 million. So it's going to go up 130x. If you listen to his forecast closely, the problem with when people hear that, and if they're believing that Michael Saylor's right, is what does $100,000 buy you today? It buys you a Cybertruck, a fully loaded Cybertruck, to put an example on it. Well, in 20 years, when it goes to 13 million, does that mean I could buy 130 Cybertrucks? Or if you listen to Saylor, you've got to protect yourself from the traditional financial system. That's a word for inflation. That if it goes to 13 million, that a Bitcoin might still get you one Cybertruck at 13 million, or maybe a used Honda. So you continue with the metaphor. But if you're in traditional financial assets, you'll be buying a bicycle, is basically what he's saying the day that it hits 13 million. That is a far different scenario. Well, if that's the case, and look, I'll say, look, I'm open to the idea that the traditional financial system might hit headwinds and might have problems. What he's arguing is that crypto, Bitcoin, is an alternative. Okay, then stop acting like a levered version of the NASDAQ, not the S&P, but of the NASDAQ. It acts like a lever. It goes up 2x when the NASDAQ goes up. It falls 2x when the NASDAQ goes down. It needs to start having a zero correlation to the traditional financial system. Well, that could come with more development of more protocols, that could maybe make it look more like an alternative to the banks and the brokerage firms and the stock exchanges that we have and that we trade dollars on. Create crypto banks, brokerage, stock exchanges that we create Bitcoin on. And that is coming. But when it arrives, it should have a zero correlation. The problem with it having a high correlation to the NASDAQ is it is correctly impugned by TradFi as a big speculative tool. Is all it is. It just goes up and down with the speculative winds in the market. So that's what I'm more concerned about is you've gotten the deregulation story behind you. It's looking more like a speculative asset than it's looking like an alternative asset. I wish it would start to look more like an alternative asset. That to me could then start to see it really start to flower. Because otherwise what you're really betting on with crypto, and you saw it in the last couple of days, that it went from 107,000 to 95,000 on the Fed meeting, is you're just betting on the same things that TradFi is betting on. You're just doing it with a lot more vig, that it just moves in bigger percentages. So what I just said, Ash, we were talking offline about this. I think what I said is I'm 75% bullish on crypto, 25% skeptical on it. I am net bull on crypto. But the maxi crowd is, I'm not 100%, so I got to be burned at the stake as a heretic. And I'm saying that is also, don't fall into that trap too. Every investment has promise. Crypto has promise. I've given you the idea that if it becomes an alternative and breaks the correlation, it's got a lot of promise, but it's got to do that. So the skepticism is fulfill that promise, is what the skepticism is. If the argument is the FOMO argument, we hit 100,000, so everybody's going to panic and have to get into crypto. Well, the Wall Street Journal could only find two guys that bought $1,000 worth of it for their story. They didn't find somebody at the Greenwich Country Club that sold his S&Ps and bought millions of dollars worth of crypto after it hit about $100,000. If your story is FOMO, your story is that somehow people are going to be chasing it because it's a multiple of the NASDAQ. I think that the problem is we're not seeing that right now. And I want to see, and I would last and continue with, if you want the people with a lot of wealth at the Greenwich Country Club to plow it in to Bitcoin, show them that it has got zero correlation. Show them that it is building something different than what we see from JP Morgan, the New York Stock Exchange, and the Fed. And they will put a lot of money into it. But if your argument is, it's just buying the NASDAQ on leverage, they're going to shrug their shoulders and go, there is an ETF called TQQQ, which is the triple levered QQQs. I'll buy that instead. Thank you very much.
Jim, this is why these conversations are so important, because it's a meeting of worlds. You point out there's a different worldview that you have for people in the digital asset crypto community, Bitcoin community, who are so passionate about these assets. And then you have a different way of looking at the world that you've just highlighted here today, and compared and contrasted them, the way that professional institutional investors look at markets, how they evaluate those investment decisions. You contrasted it, you laid it out for us. I think it's so important to have these kinds of conversations where you have you, Jim, one of the few people who are conversant in both of these worlds, who has spent the time and invested the energy to understand the way the crypto space works and compare it based on the experience that you have of working for all these decades in traditional finance.
So let me finish off with a quick thought to say it a different way. We've got this favorable regulatory environment for digital assets, and Bitcoin is benefited from it. And what you hear, at least maybe I'm too online, is you hear that means now that that's clearing the way for FOMO. No, it should be clearing the way for development. It should be clearing the way that a developer that invents a mixer doesn't go to jail, like we've seen that's happened in the past. Russ Ulbricht gets a pardon because we're not going to create a future Russ Ulbricht. We're going to allow developers to develop things, allow them to create an alternative financial system. That's what you should be looking at with this deregulation wave, not that we're just going to create a FOMO wave of everybody's got to get into the coin because it's gone up and therefore it will continue to go up on a giant momentum play. If we start to see that being pushed, that it's going to open the road for more development, more experimentation, and that we're more of an alternative financial system, then yes, that clears the way for huge price gains on what Michael Saylor was arguing, is it's becoming an alternative to what we have. It's becoming somewhere that you want to protect your money with. Like I said, what I'm afraid of is, we're going to get off everybody's back. So now, we can have a giant FOMO wave. I think we already had it. And that's why we're at 100,000. And I don't know if we're going to have another one at this point. We need to have a development wave to get higher prices.
Yeah, and I think people who are passionate about the technology like me are feeling the exact same way that you are there, Jim, which is this development is so important. And by the way, there are still some real material challenges. You see it in terms of the security incidents, the exploits of some of these protocols, particularly in the DeFi space that we saw so many of, unfortunately, in 2023, and increasing and to perhaps a lesser extent in 2024. And by the way, user experience, user interface issues. My mom still does not have an Ethereum wallet. There is a lot to be done here. So much opportunity for development for the developers, for the builders who are passionate about this space, to come in and increase the functionality, increase the usability, decrease some of the risks from a security standpoint. I really hope all of that stuff starts to happen, not just in 2025, but out, to 2029 and beyond, as we have these conversations, by the way, which I think are so great and so important to have these meeting of the minds talks. You talked about the decrease in regulatory headwinds, some of the mental model stuff that we're talking about, particularly if you want to hear something with regard to Scott Bessent, the presumptive incoming Secretary of Treasury. I did a conversation with him on Real Vision, a deep dive like this, a full 60-minute conversation where we explored his just views of the way that markets work. I think it's incredibly helpful to people who are trying to get a sense of what is going to be coming next from the upcoming administration. That is available on the Real Vision platform, of course, but also on YouTube. Go check out my conversation with Scott Bessent if you're interested in more. By the way, Jim, we've talked so much about the equity markets. Maybe the place to end this conversation, something that I expect our viewers and listeners don't want to end. Talk a little bit about your 2025 outlook for U.S. equity markets. We framed up the broader narrative here. Talk about what you see happening in the short to intermediate term, the next 6 to 12 months in U.S. equity markets.
Struggle, higher prices probably by the end of the year, but a struggle in between. I don't think we're going to have another big kind of gain in the market. I think we're going to see higher interest rates, and that from a TradFi perspective is going to be a competitive, competitor. Why should I be beating my brains out in the stock market? Remember, from this moment forward, I know you made a lot of money in the last 2 years, but that's done. What am I going to do in the future? So if we're looking at, mid-single digit type of gains in the stock market with some volatility, and you could get that in the bond market with a lot less volatility, that's going to be kind of the competition that I think it's going to go through. I think that what's going to be driving that volatility is going to be what we talked about, that impatience about AI. I get it. I'm there. I think it's bigger than the internet, but it's got to happen now. It cannot be happening somewhere, off into the future, because it's priced to happen right now. And maybe there's a disappointment that it's coming, it's going to be good, but it isn't happening right now. And those professional investors are saying, well, that those future gains with higher interest rates are worth less. I'm on to something else. I'll be back here later when it's closer to reality.
Jim Bianco, I hope you'll come back and join us in the new year to have conversations just like this one. Such an important and powerful one. Jim Bianco, thank you so much for joining us right here on Real Vision.
Thank you.
Hey, by the way, just a reminder before we go, tickets for the upcoming in-person crypto gathering in Miami up for sale right now. You can get them over on the Real Vision website at realvision.com/CG2025. That's realvision.com/CG2025. I will be there. It's going to be a hell of a lot of fun. Come on, it's Miami Beach in the end of January. You want to not be in New York if you're like me. Get out, come down, enjoy the weather, enjoy the conversation. Thanks so much for joining us. See you soon. See you in the new year. Have a great holiday, everybody.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.